Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh.
Good afternoon, everyone. This is a general lecture session with our speaker, Mr. Jazib Ali, MSc. If everyone is ready to start, I will open this session. Before we start, I would like to remind you to open your camera and mute your audio. Also, I would like to inform you that you should rename your name to your full name since it will be used in the certificate. The Honorable Mr. Jazib Ali, MSc, as the lecturer for today's event, and the Honorable Mrs. Fitri Wahyuni, SA, MSc, as a head of International Program for Accounting. Alhamdulillah Rabbil Alamin. Wassalatu wassalamu ala asrafil anbiya wa mursalin wa ala alihi wa sahbihi ajma'in amma ba'du. Praise to the presence of God Almighty, who still give his guidance and mercy to all of us so that we can attend this general lecture in a good health. Blessings and greetings let us always devote to our Lord, the Prophet Muhammad sallallahu alaihi wasallam, who had brought us from the time of Jahiliyyah heading into the era that is full of inayah. The topic of today's general lecture is working capital management, which will be delivered by our special speakers today, Mr. Jazib Ali, MSc. Firstly, let me introduce myself. My name is Muhammad Arif Sebastian as the Master of Ceremony. Here, I would like to show you the agendas we have arranged today. The first agenda is opening. The second agenda is general lecture session. The third agenda is questions and answer session. The next agenda is a photo session. And the last agenda is closing. Let us start the first agenda, that is opening, by reciting Basmalah together. Bismillahirrahmanirrahim. The next agenda is a general lecture session in the subject of financial management with the topic working capital management and will be delivered by Mr. Jazib Ali, MSc. For Mr. Jazib, time is yours.
Thank you very much. I would like to share my screen. So if you could kindly give me the rights.
Yes, sir, sure.
In the meanwhile, although I know that I'm supposed to speak in English over here, but I have a few Indonesian words. I was in Indonesia a few months earlier, and this is my second collaboration with International Program of Accounting. So I hope you are doing well, and Selamat siang, apa kabar?
Selamat siang too, sir. Alhamdulillah, we good.
Thank you. How's the weather over there?
I think it's really sunny in here, and it's afternoon.
Right. I've still not received the rights for screen sharing. Over here, it's a bit snowy. There has been snow for the last 2 days, so it's quite chilly over here.
Oh, I see. It's still snowy, yes, sir.
Yeah.
But you're still in good health, sir.
Yeah, I'm good. Thank you. I still can't share my screen. Can you make me the co-host or host so that I am able to share my screen?
Sure, sir. Wait.
Yeah, thank you very much.
Is it available, sir?
Yes, now it's available.
Okay.
Can you all see my screen now?
Yes, sir, we can see it.
Give me a minute. Is it still okay?
Yes, we can see it.
Okay. So as my brother already informed that we will be discussing the topic of working capital management in today's lecture. Can you please tell me, like my first question would be that what is the level of this audience? Are they master's student, bachelor's student, so that I understand that how much they know about finance or working capital management?
Mostly it's undergraduate students, sir.
Undergraduate, so very less information or very less understanding of finance.
Perhaps, sir.
Yeah, okay. So I will try to keep this brief, and I will try to simplify this as much as I can. And if you have any questions, please feel free to ask. In financial management, working capital is one of the most important topics, because working capital is like managing your day-to-day policies about how you are going to conduct the business. So if there are any flaws in the policies, ultimately it affects the whole business scenario. And if the business is not running well, if the company is not earning profits, ultimately the business will have to shut down, and all the investment you have put into the business will be lost. All the employees will lose their job as well. So the most important thing is, how are you going to manage your working capital? Now, in this topic, in this chapter, we will be discussing the working capital policies, cash, inventory, and account receivable management. Account receivable, inventory is the stocks that you are going to sell to the consumer, to the customer. Account receivable are the is the money that you have given to the customers, but you have not received cash for it. Like, you have sold your product, but you have not received cash on it, and you will be receiving the cash later on in the future. Accounts payable management is like, when you make a product, you need some kind of raw material. So you purchase the raw material from a vendor, but right now you have not paid for it. You will be paying for that raw material in the future. So there is a gap between account receivable management and account payable management as well, which we will be discussing. Since, like, you have not received the cash from customer, you have still not paid the dues to your vendor for the raw material, there is a gap of financing. So we will be discussing short term financing. Short term means any financing, any asset, any liability which has a life of 1 year or less than 1 year. If any asset or liability has a life of more than 1 year, it can be either medium term or it can be long term. Medium term is normally around 3 years, whereas long term is 5 to 10 years. It can be more than 5 to 10 years as well. Like, some assets are, if you take a house loan, it can be 20 years. So again, it will be classified as a long term, but the lifetime for that loan is 20 years. Bank debt and commercial paper. Bank debt can be your short-term debt, which you are taking from the bank to finance your operations. It can be short-term, it can be again long-term. Commercial paper is like a big giant corporate company which issues their bond, right, to raise their to raise equity and to raise their uh, long-term ability of financing the operations. So there are a few basic definitions which I want to share before we can further dive into the chapter. First of all, what is gross working capital? So gross working capital is your total current assets. Can anybody from the class tell me what are current assets? Feel free to share. Anyone?
Yes.
Yeah, please go ahead.
Yeah, I think current assets are assets that the business can easily convert into cash.
Yes. So current assets can be your cash, inventory, your account receivables, any asset which has a life of less than 1 year, 1 year or less than 1 year. It can be your prepaid insurance as well. So uh, if you have bought a car, right, and you have to pay insurance for it, so you always pay insurance in advance. So sometimes you pay the insurance for a quarter, for a half year, or maybe for a year, maybe for just 1 month. In all those scenarios, prepaid insurance can be your current asset as well. Also, if you have taken a long term loan from bank or anything like that, then bank or any financial institution, so there will be a portion of liability which is due in 1 year, less than 1 year. So that would be your current liability as well. Now, coming to net working capital. What is net working capital? It is basically the difference between current assets and current liabilities. Like I already informed, current assets can be cash, inventory, account receivables, prepaid insurance, your current portion of long-term loan receivable. There is a difference between receivable and payable. I will come to that. But current portion of long-term loan receivable can also be your current asset. Now, current liabilities are the opposite, which you owe to someone, like you have taken a loan from someone. Current assets are your assets, like people owe you. People have to give it back to you, or something you own right now. Like if I have cash, I own the cash. If I have inventory, I own the inventory. If I have account receivable, then someone will have to pay me back the money. Maybe sometime in future, but yes, they owe me, so technically, it's my asset. I will be getting paid for it. Current liability is totally opposite. This is something I owe. I have to pay to someone. Like I have to pay to my friend over here. I have to pay to a bank, anyone. Like this is my liability. Ultimately, it is a cash outflow. Like the cash would be going out of my pocket, would be going out of my bank, would be going out of my wallet, right? So current liabilities can again be your account receivables, it can be your wages, it can be your taxes, anything like that, right? You have bought an inventory, so you have to pay the amount for it, so accounts payable. Now, what is the difference between net operating working capital? Net operating working capital is basically operating current assets minus operating current liabilities. So uh, we have understood, we have read two terms over here, current assets and and operating current assets. The only difference over here is between current assets and operating current assets is that all other assets except cash, inventory, and account receivable. So in a business cycle, we use three current assets: cash, inventory, account receivable. Apart from these three, all other current assets are excluded. They are not technically in the business cycle. Although insurance would be a part, if we don't do insurance, then we cannot protect our machineries, our vehicles, our property. But it's not in the cycle of making your product, selling your product to the consumer, and getting your money back. It's not in that cycle, which is why we exclude that. So operating current assets would only be cash, inventory, and account receivable, all only these three. And operating current liabilities would be your accruals and your account payable. Account payable, I've already informed that it is a money that I owe to someone. Like I bought raw material, so I have to pay to the vendor, to the supplier for that raw material. But maybe sometime in the future, maybe within 1 month, maybe within 3 months. The maximum it can be is 1 year, not more than 1 year. Accruals can be your wages, which you have to pay to your labor, as well as taxes, which you have to pay to the government. So when you are conducting a business, you pay to your labor the wages, the salaries, your employees, and if you make any profit, then you pay taxes to the government as well. So in this scenario, accruals would be your wages, the salaries, the wages, and apart from that, the tax liability which you owe to the government. So working capital management, as I informed, that it is a day-to-day control of the policies and how you are supposed to manage your business to increase your efficiency and effectiveness of running the operations. So it involves cash, inventory, account receivable, accruals, accounts payable, as we've already discussed. The working capital policy can be the level of each current asset. We need to determine that how much cash we should have in our bank, or as cash itself, like hard cash, as a petty cash for day-to-day requirements. And apart from that, how much inventory we need, how much raw material we need, right? How much finished good we need to keep, so that our product are on the shelf in the market all the time, and we don't run out of stock. We need to cater to the demand of our product in the market as well. So if we are not catering to the demand, if we are not forecasting to the demand, then there will be chances that our product is not available in the market anymore, and we lose our customers. So we need to understand, we need to identify the optimum level of current assets, inventory, which are available in the market, and the cash we need, the raw material we need to finally convert into a finished product. And apart from that, the most important thing is account receivables as well. So although, okay, fine, we got our product, we have money, we are supplying well, we are putting our product on the market, we are giving credit to the customers, they are buying our product. But what if they are not paying us? Like they are buying our product on credit, on loan, but they are not paying us on time, then it is another scenario where the business can go, where all the things can go wrong. The business can, bankrupt as well, can go bankrupt as well. Because if we are not receiving our money on time, we will not be able to pay to our suppliers on time. The supplier will not deliver us the raw material. We will not be able to convert it into the finished product, and ultimately there will be a shortage of our product in the market. The customers will not buy it. So we need to understand how are we going to manage all of these current assets effectively, efficiently, and what is the optimum level of our product. Uh, the final point on this slide is how current assets are financed. Now, finance is like how you are going to pay for it. Sometimes you pay for an asset in cash. Sometimes you pay through a liability. The liability can be a loan from the bank, or it can be managed through other accruals like accounts payable, accounts accruals as in the wages or the taxes. So you have, in economics, you must have read a term scarce, resource scarcity, which means that all resources are ultimately limited. You don't have unlimited thing about unlimited quantity of anything. You cannot have unlimited quantity of rice. You cannot have unlimited quantity of wheat. You cannot have unlimited quantity of money. It's all scarce. Like you have to pick and choose, which means you have to have a opportunity cost. So if you are going with one thing, you have to lose, you have to forego the other thing. You cannot have everything. So which is why we need to understand how current assets are financed. We need to understand which current asset or which liability right now is most important for me, and how am I going to finance my current asset? How am I going to run my operations? The next slide, cash conversion cycle. Cash conversion cycle is basically the time between payments made for materials and labor and payment received from sales. Like I have some raw material which I acquired from, which I procured from a vendor. I have my machineries which I use to convert my raw material into my finished product. I have my distribution channels. I use my distribution channel to put that final product, finished product, into the market, right? I have my marketing team who will advertise for the product, and they will ultimately help in generating sales, which means the customer is buying my product. Now, once the product is finished, once the product is sold, I I receive my money from my customers after a certain days, maybe right away at the at that moment, at the spot, if the sale is being made on cash, or after maybe 1 week, 1 month, 3 months, when the product is being sold on credit or on loan. So these are the terms that we agree with our customers. So the time between payments made for raw material and labor is again wages, salaries, and payment received from sales. This is, we call it cash conversion cycle. So cash conversion cycle is basically your inventory conversion period, in how many days your inventory from raw material to your finished product, and ultimately to the hands of your customer, your consumer, the whole cycle from a raw material to final product, and then sold as well. How much time does it take? The receivable collection period is in how many days you get your money back from your customers. And payable deferral period is in how many days you pay your vendors, you pay your suppliers for the raw material. When we use this equation, it ultimately gives us a scenario or a figure in days, which tells you in how many days you complete one cycle of your entire business. Like in a cycle, again, as I told you, in one cycle, it means you procured raw material, you convert it into a finished product, you put it in the market, the customer buys it, and the customer pays you for it. And then when you get the money, then you pay your supplier for it. So in how many days this cycle is completed? And when we divide that day into the business, into the number of days, from 365 in a year, 365 days in a year, it tells you in how many times you run the complete cycle of a business in a year. The higher the number is, the effective your business is going, and you are making more money out of your business. So inventory conversion period, average time required to convert materials into finished goods, and to sell those goods. I think the definition is self-explanatory. It tells you that you have to buy the raw material and then convert it into finished good using your machinery, using your labor, and then you have to sell the product into to the customer, right? So the formula for this is inventory conversion period is equals to total inventory that you have. Inventory again is a current asset. So on the balance sheet in the uh, current asset portion, you will find an inventory figure. You will divide it with sales per day. So sales, you would find out the figure of sales from income statement and divide it with 365 days in a year. So inventory conversion period becomes total inventory divided by sales divided by 365. Sales per day means sales to annual sales divided by 365. Receivable collection period, it means the average length of time required to convert the firm's receivables into cash. Some customers pay, like when you go into a market and you buy milk or you buy bread or something like that, you pay to the vendor, you pay to the shopkeeper in cash. So customers sometimes pay cash, but some customers, some corporate clients who make bulk purchasing will require uh, credit to pay for that purchase because they do not have right away the big amount of money in their hands or maybe in their bank to pay for it, and they negotiate as well. Of course they have to manage their working capital cycle, so they negotiate terms with the other corporate client or with the supplier that we will buy this much product from you, however we will pay you in 7 days time, in maybe 1 month time, and we also need 2% discount, 3% discount on our total purchase. So when you are making bulk purchasing, when you are making large orders, then you get some discounts as well, and then you get some credit as well. Credit as in the agreement that yes, you can pay us after these many days. So average length of time required to convert the firm's receivable into cash, it is called receivables collection period. This is also called days sales outstanding. It's the same thing. Like sales outstanding means you have made the sale, but you have not received money for it. So the sales are still outstanding. So the formula for it is receivables divided by sales per day. Annual sales per day means sales divided by 365. Sales, as I told you, you would get the figure from income statement. Receivables, in the current asset portion of the balance sheet, you will find out the figure for receivables. Payables deferral period. It is the opposite of receivables period, receivable collection period. Over here, you are negotiating a term with one of your suppliers that I would make a bulk purchasing, but I would pay you in maybe 7 days time, 10 days time, 1 month's time. So you have to negotiate. What is a difference between what is a good strategy, in fact, between receivables and payables? It's that receivable, you receive it as soon as possible, but payables, you delay it as much as possible. So you receive the money as soon as possible, but you pay the money out, the deferrals, as much as you can. You have to delay it so that the money stays in your bank as much as possible, and you can use that money into some kind of other operations or some kind of emergency fund, or if you see an opportunity, then you use it. So payables, you can actually, you are using payables, which is some others money, some other people's money into your business. You are not putting your money into the business, but you are using someone else's money to increase your operations. So payables deferral period is payables divided by purchases per day. Payables, again, you will find out income statement, balance sheet on the current liability side. Purchases are on the income statement, and it can be called as cost of goods sold as well. So cost of goods sold is how many cost, including the raw material, the labor, the overheads. Like overhead can be your rent, your electricity usage, anything like that. All these costs combined divided by 365, you find out the cost of goods sold in 1 day. So this is just a example of how we are going to calculate cash conversion cycle. So assume that sales of a company is $10 million. Cost of goods sold is $8 million. The company has an inventory of $2 million. Account receivables are 600,000 plus. account payables are again 600,000 plus, and days in a year are 365. So how are we going to do it? First of all, we will calculate inventory conversion cycle. So inventory conversion period is inventory divided by sales per day. So as we know that inventory is $2 million, which is the third figure over here. And then sales are $10 million. So the sales $10 million divided by 365, and the inventory are $2 million. So you find out that inventory conversion period is 73 days. Like in 73 days, you buy raw material, you prepare it, you convert it into, you do your magic, the machinery and everything, you do your magic, and the raw material is converted into a finished product. And then you have your marketing and distribution channels. You put your inventory on the shelf in the market. The customer comes, customer buys for it, right? When the customer buy the inventory, that one product, that one unit of your product is sold. So the situation from raw material into the selling or the sales of one unit or more than one unit of inventory, it is called inventory conversion period. So in 73 days, it takes 73 days to sell one inventory unit. And of course, you can sell as much as you want inventory within one day, depending upon the forecast, depending upon the requirement demand of your product in the market. Receivables collection period. A receivable collection period is again in how many days you receive your money back from your customer. So in this scenario, the calculation becomes 24 days. So it takes you 24 days to receive your money back from your customers. Normally, the companies can allow from a 1 week period to a 1 month period to the customers to receive their money back as credit. So this is somewhere between 1 week and 1 month, 24 days. So which is fine, but the idea is to bring this figure down as much as possible. Also, of course, bring the inventory period as much down as much as possible, because if the inventory is taking too long to sell, then your product is not in good demand. If the inventory is selling in maybe 30 days, 20 days, then it means that your product has a high demand. And if you are receiving your money back in less days, then it means that you hold a good amount of sales in cash, and you are not reliant more on credit sales, which is also a good thing. But at the same time, it can also hurt your sales, because you are not exploring more options to increase your sales, because the bigger clients, the corporate clients, will always negotiate with delayed payments. So it should not be too low. It should not be, the receivable collection period should not be too high. It can be somewhere between 7 to 30 days. And in this scenario, we find out that it's 24 days, which is, I cannot say optimum level, but yes, it's a good, reasonable amount of time. Payable deferral period. Payable deferral period is again, we have to pay to our supplier, but we negotiate with the supplier that we are making so much purchases from you. We need some discount, and we will need some amount, some days credit, some days loan, so that we can pay it back in a few days time or maybe a month's time. Over here, as you can see that the payable deferral period is 30 days. So normally, as I told you, that receivable collection period and deferral collection period, more or less, it's the same thing, but opposite scenario. So over here, we are delaying our payments, which is a good thing. We are paying back to the vendor in 30 days, but we were receiving our money back in 24 days. So which means the six days difference is basically improving our business, which is a good thing. But if we are collecting our money, the receivable days is 40 days, and we are paying the suppliers back in 30 days, then it means that we are losing 10 days in each cycle, and those 10 days are actually hurting our business. So receivable days should always be similar to payable days, or if it's lesser than payable days, then it's even better. But in any case, the receivable days should not go beyond what payable days is. So cash conversion cycle, this is a simple formula of cash conversion cycle. It says that inventory conversion period plus receivable collection period minus deferral period. So over here, the cash conversion cycle is 67 days. So 67 days tells you that within 67 days, you convert your raw material, you buy a raw material, you convert it into finished goods, you make the sales, you collect the money from your customer, and then you pay back your supplier as well. So, like the whole business cycle, the customers are paying you, they like your product, they pay you, and then you keep on paying to the supplier. So the supplier is happy, they will provide you with more raw material, you will again convert it into finished good using your machinery, then you put it to the supermarket or maybe into the big giant clients or consumers, you sell it to the retail clients as well, and the product has good market, so which means that you are making sales and they are paying you as well. So 67 days is a good time. But now what does 67 days mean? 67 days mean that we know that in a year there are 365 days. So 365 days divided by 67 days, somewhere around 5 to 6 times. So you are converting your business cycle, you are making a business cycle in a year about 5 to 6 times. So in a year, you are making 5 to 6 times sales, which you normally generate in one cycle. Like in one cycle, if you generate a sales of $5 million and you are repeating this cycle 5 to 6 times, then your annual sales would be somewhere around $25 million to $30 million. So as much as this cycle cash conversion cycle is low, it is better for the business. This is basically I have given you a diagram so that you can understand. Inventory conversion period, again 73 days. Finished goods and sell them, you have to convert them into finished good and you have to sell it. Receivable collection period is basically getting the money back from your clients. After that, payable deferral period is you receive the raw material from your vendors and now you pay for it. Pay cash for the purchase material, and eventually the cash conversion cycle means how many times you are repeating this cycle, in how many days you are getting your money back for the from the client, you are paying to the suppliers, and the whole business cycle is basically done in this diagram, where you can get an idea of how the business is running. The objective of cash conversion cycle is basically to shorten the cash conversion cycle as much as possible without hurting operations. Uh, Reduce inventory conversion period as we discussed, process and sell goods quicker, reduce receivable collection period, speed up collections, lengthen payable deferral period, and slow firms payment. It means that you have to delay your payment, you have to delay your outflows as much as possible so that cash stays with you. Increase the receivable period so that speed up collections, you get your money back. But can someone tell me, process and sell goods quicker? What if we are not able to achieve it? And what are the problems if we are not able to sell the inventory quickly? What can happen with us? Anyone? Inventory conversion period, can anyone share what they think? If we are not able to convert the inventory, sell the inventory?
Yes.
Yes, please go ahead.
Yeah, I do think like if the business is not able to sell their inventory,
Okay.
they were not able to generate the cash that they needed to pay back their suppliers. And yeah, if that happens, then it will make the business not to run well. They will not able to buy new supplies to make finished good and sell them. So obviously the business will run out of cash.
Right.
They will not have enough.
Right. Yes. May I know your name, sir? And what can I call you? Are you from
Joe.
Nigeria?
No, I'm from Gambia.
Gambia. I was in Gambia in June. How is the situation over there?
Oh, okay.
Yeah. So Gambia, the smiling coast of West Africa, right?
Yes, that's how
Yes,
they label it.
Yeah. Yeah, I was there in June last year, so it was quite a wonderful experience. So Jao explained very well, and the only thing I would like to add over here is that sometimes our inventories are like can be perishable goods like fruits, vegetables, eatables, anything like that. Sometimes our inventory can be technology as well, like mobile phones, laptops. So if we are not selling our product on a quicker note, like quickly, if we are not selling our inventory quickly, then sometimes the product will perish, will go to waste, will be rotten. We will not be able to sell it to the market. And sometimes, like in technological aspect, if we don't sell our mobile phones or laptop stock within a specified period as soon as possible, then of course there would be a new model of mobile phone, a new model of laptop or iPad or technology would be coming in. So our inventory would be like, would not be relevant to the market, would not be competing with other products in the market. So it's equally important that we sell these products, especially these products, as soon as possible. Of course, we need to sell the other inventory as well, like cement, steel, and anything like that as soon as possible. But if even if they are delayed, the thing is that our whole business cycle would suffer and our sales are impacted, our name in the market is impacted, that this client sales, this client product is always like sitting on the shelf and no one is buying it, then it's not good for the reputation of the company, because it says that word of mouth is everything. So if there is a good customer of you, which is a loyal customer, and they talk to you and they buy your product and they support you, or they inform your friends, inform their friends about your product, then they will be able to generate sales for you as well. One good customer brings 100 more customers, it is generally said. But if that customer does not like the quality of your product, and it's a bad customer, and they are not loyal, and they always find out flaws in your product, then they will inform this to your other clients as well, other customers as well. And one bad customer takes away 100 more customers from you. So you need to inform, you need to ensure that your inventory has good quality, up to date, what's going on in the market. You provide them the solutions. Inventory is not like selling anything you see and you can prepare. Inventory should be a solution to the problem. So you understand the market, you research the market, you see that what kind of problems a person is right now facing, a common person is right now facing, and you develop a product according to it, so that problem is resolved. So once the problem is resolved, then it means that they find something which can actually help them, and they will be happy with your product, and they will like patronize you, they will inform their other friends, they will spread the word of mouth, and ultimately it benefits you. Okay, real-time computer, I have given another formula. This is basically the same situation, just I have changed a few variables over here. In inventory, the annual sales and cost of goods sold are same. Inventory correction period, I have decreased from 73 to 65 days. Receivable collection period, I have decreased from 24 to 23. Payable deferral period, I have increased from 30 days to 51 days. Now, cash conversion cycle previously was 67 days. It now becomes, it is shortened to 57 days. So in this scenario, inventory, receivable, payables, in this scenario, we will be able to save $268,000 in our money, and it will be a less cost that business has to incur, and it saves you some money, so that you can use this $268,000 into some other kind of business opportunity. You can enhance your operations, you can dive into a new business operation, you can increase your inventory, or you can invest into marketable securities, or you can just keep this cash as emergency fund. Alternative net operating working capital policies. There are basically three policies, which are restricted, moderate, and aggressive. We will be discussing these later on in detail, but it means basically that restricted means you hold minimum cash and inventory holdings. Your credit policy is really tight, like you don't allow much credit to the customer. It can be maximum 7 to 15 days. Receivables, you try and keep it as low as possible, which means that the most of your sales are cash basis, and payables and accruals are maximum. Payables, like you negotiate with your supplier as much credit period as you can, so that you can delay your payment. And accruals also, you delay the wages of your labor, you delay the taxes for the government as well. But all these, if you, everything has a cost. Like if you delay your wages to labor too much, then ultimately labor is going to leave you. If you delay the taxes to the government too much, then ultimately the tax authorities are going to raid your company. Like, why are you not paying our dues? So you have to make a balance. Moderate is like you keep everything moderate, you keep everything like not too much, not too low, but somewhere in between. Aggressive is like you hold inventory and cash too much all the time. Like you are very confident about your inventory, you produce too much inventory, maybe because you are an important client like Walmart, like Amazon, like some other big giants like over here in UK, Tesco and other supermarkets. They hold inventory holdings very at a very high level, because they know that the footfall in their supermarket, footfall means the number of customers visiting per day. The footfall is very high into those supermarkets. So generally they keep the stock at very large quantities, because if they don't have a particular product, the customer will have to go to the competitor. And like, if I give you the example from UK, there are multiple supermarkets over here. It can be Tesco, it can be Asda, it can be Sainsbury, it can be Morrison's. So let's say if I want to buy a particular flavor of yogurt, flavored yogurt, vanilla flavored yogurt, let's see, and I don't find it on one of the supermarkets. So I will go and buy it from the another one. But somewhere in my mind, it will be there that, okay, this particular flavored yogurt is not available on supermarket A. And now I have to go back, I have to go and buy it from supermarket B. So naturally, this will be in my head, this will be in my brain, and I would be ultimately becoming a customer of supermarket B instead of supermarket A. So things like that, happen day to day. Credit policy is liberal. You allow the credit to your customers as much as possible, and you are not very concerned about that, because you know that your customers are your loyal customers, faithful customers. You can trust them, and they have always paid on time. Receivables are large. Again, as I told you, this means that you trust your customers and they will be paying you. And payable and accruals are minimum. Accruals, like you pay your customer, you pay your employees and your labor on time, and you pay your taxable dues on time, as well as the payables, you pay your vendors on time, so that they keep on supplying you with the raw material, so that you can keep on generating, you can keep on making finished products. Any questions so far? Any questions? Anything not clear yet?
No, sir.
Okay. Thank you. Okay. So cash is cash management. Cash is basically a non-earning asset. It can be an earning asset as well. If you put your cash into savings account, you will earn some interest. But if you just keep the cash in a current account, in your wallet, in your just pocket, then it will not give you anything, any further return. So transactions must have some cash to pay current bills. So always keep some cash into your bank, so that you make arrangement for emergency situations. You make precautionary balances like safety stocks, you pay urgent due bills, and you pay for petty issues in the office. And apart from that, compensating balances for loans and or services provided. You have to pay back money for the loans that you have taken or the services that you have received. Speculation, take advantage of bargains and take discounts. So sometimes what happens that there are sales in a year multiple times, like Black Friday, Christmas sales, New Year sale. I'm sure there must have been some kind of sales in Indonesia as well. Like I come from Pakistan. Right now I'm in UK, but I'm basically from Pakistan. So we have our sales like Independence Day sale, or apart from that, 23rd March, there is another day sale. So things like that. So I'm sure Indonesia must have some other sales as well. So during those sales time, the prices of the product go very low, or sometimes you get a good deal from one of your other supplier, which is a bargain, which is very low priced. So you can take advantage of it, and you can sometimes the customers, the suppliers also provide discount if you make the payment in cash. So they say that if you make the payment right now, then and there, then I will give you 2% discount, 3% discount, or maybe 5% discount. But if you pay me back in 30 days, then you will have to pay the full amount. So if you have cash available and a good quantity of cash available, which is sufficient, and you make the calculations, of course, the finance team will tell you about this. They make they do a projection scenario, and they will tell you that how much cash are we going to save if we buy this raw material in cash, like pay right now, there and then and there. So they will make some assumptions, they will make some calculations, and they will inform you. So it's important to have some cash as well to take benefits of these bargains and discounts. Cash budget, the primary cash management tool, it tells you projected cash inflows, outflows, ending cash balances, forecast loan needs, and funds available for temporary investment. It can be your daily, weekly, monthly, depending upon the budget's purpose. The cash managed budget can be daily, weekly, or monthly. Monthly for annual planning, of course, and daily for actual cash management. So it tells you basically how much cash are we going to receive in a day, in a week, or maybe in a month's time, how much are our expenses, what cash we will be left with after the budget period. It can be one day, as I told you, it can be 7 days, it can be 1 month, and how much funds we will need from bank or from our other sources so that we can maintain our business cycle. Monthly would be basically for annual planning. We know that what our monthly budget was in January, Feb, and March, and so on and so forth. And using the historical data as well, we will be able to plan it for the next year as well. And daily is for actual cash management. It tells you how much cash we are short on and how much we need to borrow from the bank or from our other sources, other financial institutions, or how much cash we have to invest from our own pocket so that we keep on running our operations. Data required for cash budget, again, it's since we are creating a projection, then there will be sales forecast. Information on collections delay, we assume that collections might delay. It can be because of economical scenario as well. So right now, although we have recovered from COVID, but we know that during the COVID, the markets were closed. Most of the markets were closed and the sales were not happening that much in the market. But of course, if you were doing online purchases, then that was a different scenario. So sales of many clients reduced. The collection periods were delayed because people did not have enough money to pay you. So the collections were delayed. Forecast of purchases and payment terms, it was increased. Even in Pakistan, the state bank, allowed all the banks. In fact, allowed is not the word, but instructed all the banks to increase their period time, collection period from the credit card bills, the loans, and everything, because of the changing situation and drastic decline in purchasing power of the clients, of the customers. So they increase the payable period as well. So ultimately, for the banks, it was a collection delay. First, they were getting the collection from the 1st of every month. Now they were getting the collection after maybe 7 days, maybe 15 days, maybe 1 month. So these all scenarios basically hurt a business. Forecast of cash expenses, wages, taxes. Taxes can go up and down depending upon the government policies. Right now, if I tell you that, assume, let's say taxes are 20% in the sector that you are working on, but a new government budget comes and they say that we are increasing the tax to 25%, or we are decreasing the sales, decreasing the taxes from 20% to 18% maybe. So in both scenario, if the taxes are increasing, then your liability increases. If the taxes are decreasing, then your liability also decreases. So it can benefit you, it can hurt you as a business as well. What is the initial cash on hand? How much cash did you start with? And what is your target cash balance? Like a good amount of money, a safe zone where you want to end up with. Every day, it can be every week, every month. Other cash budget line items, again, cash can also generate some kind of interest if it's in the bank, it can give you some interest as well. If you have taken a loan, then you have to pay interest on that loan. So we need to account for that interest rate as well, and we need to account for the overall interest amount of money. It can be in dollars. There is a difference between interest rate and the interest amount paid. Interest rate is basically the term that you agree with. Maybe I will pay you 5% interest for the money I have borrowed. So 5% is the agreement term. But if I take $100 from you and I pay 5%, it means that I would pay you $5. So $5 is the amount of money that I would pay you. So there is a slight difference between that. So we have to take care of, we have to be cognizant of these expenses as well. It can hurt the business. It can be good for the business as well. Apart from that, bad debt expense. As I told you that receivables are basically when you get your money back. But what if the receivables are too delayed? Like a particular client is not paying you for those expenses, for those sales that you made, and they have not paid you for maybe 6 months, maybe 3 months. So the longer it takes for the receivable to be collected, the higher the chance of bad debt expense. Bad debt expense means that debt is like the other word for debt. The other word for receivable is debt. Debt or receivable, it's the same thing. But what if the debt goes bad, which means that the receivable that we were supposed to receive from our client is now not being received. They are not going to pay us anymore. So this is a loss for the business. So we assume, generally we assume a ratio of 3 to 5% for the total receivables, and we assume that 3 to 5% of our sale, our receivables would not be received. Maybe because the customer did not like the quality, maybe because the customer don't have enough money, maybe because of some other situation, maybe because of some other dispute, they are not going to pay us back. So this becomes a bad debt scenario. So it is important to take care of the situation and be on top of your receivable management so that you can reduce your bad debt expense as well. Cash management techniques. Synchronize inflows and outflows. You make a balance, a billing cycle and a payment cycle, and you match those scenarios. You match the receivable payments with the payable payment. So once you receive receivable payment, you clear out your payables. Once you receive another receivable payment, you clear out your other receivables, other payables. So in that scenario, you do a matching concept. Matching concept is, as I told you, short-term liability with short-term asset. Short-term liabilities account receivable, short-term liabilities accounts payable, short-term asset is account receivable. So you match those scenarios. So once you're getting some money back, you put that money into bank and then you clear some of your vendors' money, the suppliers for money that you owe them. So we have to make a kind of float. Float is basically how much money you are coming into your bank and how much payments are you making out of your bank. So ultimately, it will tell you how much cash you have all the time in your bank. It gives you net float, value of net float. I will give you an example. So let's say you receive a sales, you receive a payment of $100,000 from your customers, and you owe $80,000 to your supplier. So you from $100,000 you paid 80,000 to your supplier. Now the remaining 20,000 it's still in your bank, and this will be called as net flow. So you keep a float of amount of money which is good for your expenses, which is good for your business cycle, for emergency purposes, and for a safety stock as well. Lockbox plan. Lockbox plan is basically every month you can set a target date. You can set a auto standing order from your bank, and from every month on the 1st maybe, or on the 7th, or on the 10th, that amount of money is deducted from your bank automatically and put into a lockbox plan, so that you hold some amount of money as maybe a business saving, or maybe some other kind of corporation tax saving, some other kind of value added tax saving, the liabilities which, or maybe a business investment purpose. It can be different. So lockbox is basically a pot that you create for some kind of money, and you put a standing order on your bank, and automatically every month that particular amount of money, maybe 10,000, maybe 20,000, whatever you decide, and on which date it is deducted from your actual bank and goes into your another bank account, and it keeps there. You can have access to that lockbox, but you try not to use it because now you are using this amount of money as a business saving. And apart from that, payment by wire transfer or automatic debit. So if you have credit card bills coming in, or if you have electricity bill, water bill, basically utilities and other stuff. So you don't want to miss those bills, the deadlines, and you want to pay them on time. Because if you don't pay them on time, then there will be penalties for it. So you can again set automatic debit with some of the clients. It is called direct debit as well, and the bank will directly pay them on the due date, whatever the amount is. It can be full amount, it can be minimum amount, it can be a particular amount that you want to set. So you have all the situation, all the control, and you can change this setting anytime from your bank account. Okay, reduce the need for a cash safety stock. Basically, it asks you to increase your forecasting accuracy. And the financial team, which will be working with you, have direct knowledge of how the business cycle is working, in-depth knowledge of how the business cycle operates, and they will give you a accurate forecast of how much cash you need, how much inventory you have. And apart from that, use, instead of holding cash, although cash is king, of course, but you always need to keep some kind of some amount of cash to meet for urgent situation like COVID and other things, other worldwide hazards. But use cash to buy marketable securities. What are marketable securities? Marketable securities are basically shares of a good corporation company in the stock exchange market. So instead of holding cash, if you buy a share of a good corporate client in the stock exchange, the prices of those shares or marketable securities can go up or down. So if they are going up, you can benefit from that and you can make profit. But of course, as I told you, cash is king. So you need to ensure a good balance between cash and marketable securities. Cash does not give you much return. Marketable securities give you a much return, give you a good amount of return, but it comes with a warning as well, that the value of those the value of those marketable securities or shares can also go down. So instead of making profit, you might as well end up losing money as well. So you have to balance and you have to be very careful and picking those stocks. So that is why you try to hire a good financial manager and good financial analyst as much as you can in the company, so that they give you the kind of report that you see. They are able to help you to understand or read between the lines what the market is saying, how the market is reacting. The last point on this slide is negotiate a line of credit. Line of credit is like a credit period which you are availing from the bank. So the bank can tell you that I will give you $100,000 collection line, credit line, and you can use those $100,000 of the bank's money. It's not your own money, it's the bank's money, and you have to return it to the bank on demand. On demand means whenever the bank wants. So basically, they give you a time period of 1 month, and after 1 month, they generate a bill, and on that bill, you can make the minimum payment or you can clear the whole balance. And whatever amount of money that you will be using from the bank, it will be charged interest. So you will have to pay the interest for it. Inventory management goals. Ensure that inventory needed to sustain operations is available at all time. As I gave you an example of supermarkets. So you need to ensure that the goods are available, because if goods are not available on shelf, then you will be end up losing customers. And minimize the cost of ordering and carrying inventory. So of course you need to make a balance, because if you order the particular goods, you will have to pay for the shipping. And if you order too much and the inventory is just sitting in the shelf and customer is not buying it, then you will have to pay for the warehouse cost as well. So you need to be efficient in understanding and forecasting how much inventory you need, so that you can order inventory accordingly. Again, carrying cost can be your storage and handling, insurance, property taxes, depreciation as well, obsolescence, obsolescence, we have already discussed that some of those technological product may get old or obsolete because a new version has arrived in the market, and now the customers will not be buying that technological product you are selling, maybe mobile phone or a laptop. Insurance, and insurance, you all know, property taxes is the tax of the warehouse where you will be keeping your uh, uh, product. Of course, the building is also depreciated, the regular wear and tear, storage and handling cost, again, you all know that. Ordering cost, cost of placing the orders, shipping, handling cost, you have to pay for the freight forwarding cost, the freight forwarder who would be the ship or vessel who would be taking the supplies from the supplier, the raw material, and deliver it back to you. So you have to pay for the freight forwarding cost as well to the vessel as well, and which is also known as shipping cost. And if a third party is involved from taking the shipment from your port, from the port to your warehouse, then you have to pay for the handling cost to that third party as well, because of course you will be busy in your business, you will not go to the port to collect the shipment, and the shipment can be very large as well, which you cannot collect it, so you sometimes you employ another party for moving and handling, and you have to pay for their service charges as well. Cost of running short, as we discussed already, it can be a loss of sales, it can be loss of customer goodwill. Like I gave you the example earlier, that if I don't find the vanilla yogurt in one supermarket, I will go to another supermarket. So the supermarket A lost sales because they did not have that vanilla yogurt. I went to a new supermarket and I like it more. Maybe it's closer, maybe it has more variety. Previously, I did not know it, but I now went it because I had no choice. And when I go there, I see that it has more variety. So what I did was, now I will become a customer of supermarket B, and the supermarket A would lose my customer goodwill or my customer loyalty as well. And disruption of production schedule as well. We don't know that uh, because of the changing demand scenario, we don't understand the exact production amount we need, and which is why the schedules might hurt. The calculations for the exact demand would be flawed, which is why we are running short on our inventory, and ultimately it will hurt the business. And receivable management is basically credit sales divided by days into collection period. It depends on the volume of credit sales, because sales can be cash and credit both. Normally, the situation is 20% of the sales are cash, whereas 80% of the sales are credit to the bigger clients, the corporate giants, and companies like that, clients like that. So average time from credit sale to collection of cash. Credit policy, basically you need to decide, the management decides how many days you are allowing the clients to pay for the sales that you have made. Like some clients would pay cash, some would pay in 7 days, in 1 month, but then of course you allow some discount as well, so that if the client pays you on cash, you can allow them 1% discount or 2% discount of the total bill. So if they made a purchase of $100 and you say that, okay, you can pay us back the $100 in 7 days, right? But if you pay those $100 right now in cash, we will allow you 2% discount. So instead of paying $100, you now pay $98. So these are the policies that you need to determine. The board of the company determines, and these are important to generate your sales as well. Because if you are too restricted, if you are only asking for cash sales, then the bigger clients would not come and buy, because the bigger clients would always negotiate for a delayed payment, because they have to ensure why they would discuss for a delayed payment, because otherwise they would take the loan from the bank and they will make you payment. And if that happens, then they would have to make interest payment to the bank as well, because their own money would be invested in some other kind of business scenario, some other kind of business expansion, and they would be running those operations basically on borrowed money from a bank or a borrowed money from a client or something like that. So basically the idea is to invest your own money into business expansion, and run the business on someone else's money, but ensure that the cost of someone else's money is not too much, so that your business can, get heavy duties or heavy taxes or heavy interest payments, and the business is not hurt. So this is the scenario. Credit policy we have discussed. Receivable man monitoring we have discussed. Receivable monitoring is basically you need to ensure that the client are paying on time, and if any client is not paying on time, then we need to discuss the policy with them, and we need to ensure that our expenses are the receivables are not going bad, which means that bad debt expense is not incurring. We need to keep it low, because ultimately it's a loss of sales as well for the company. Any questions?
No, sir.
Any questions so far? Okay. In that case, let's move on to the next topic, which is elements of credit policy. Credit policy is credit period, how long to pay. We have already discussed that. 7 days, 10 days, 1 month's time. Shorter period reduces days sales outstanding. It reduces accounts receivable as well, and may discourage sales as well. Because discourage sale means that if you're only making sales on cash, then you end up making less sales. Cash discount, it lowers prices, attracts new customers. Customer will be, because now if you want to buy a product online, the AI, for the artificial intelligence will tell you, the algorithm will tell you that which products are on discount right now, right? So it will be able to attract new clients as well, and it again reduces days sales outstanding as well. Credit standards, tighter standards reduce bad debt losses. It may reduce sales. So it has a balance of goods and bad, good thing and bad thing. So you need to ensure that you are managing a good situation. There is no, I would say that ideal scenario. It's always a discussion, always a scenario which you need to build, which you think is better for the company. So there is no ideal situation in this case about the credit policy and the receivable management or the payable management. It is always discussable. It is always changing, and it cannot be fixed. Depending upon the situation, you always change it. There is no ideal situation like that. But if you are monitoring credit sale event, inventory reduced by cost of goods sold, inventory increase, account receivable increased by prices, and price minus cost of goods sold is the profit. So as you all know that profit is basically the amount of money that you are making out of your product. Like if you bought a raw material for $50 and you paid $30 for the wages and everything to prepare it into the raw material, and then you sell the product for $100. So the price of that product is $100. The cost of goods sold is 50 raw material, $30 for the overheads and labor. Labor means the wages, overhead means electricity bill, utilities bill, etc. So it's $80. So on one product you made a profit of $20. So this is your profit on one unit of sales. We have already discussed this. Average daily sales, annual sales divided by 365 receivable days. We have discussed already in the previous slide. Receivable aging is very important. As I was saying, that some client might pay in 7 days, some might pay in 1 month, some might take 6 months. So it's important to it's important to understand the receivable aging schedule, in how many days, how much the amount is due. Like if you see the screen, it says from 0 to 10 days, there is $1.2 million of receivables, which is the 70% for supersets, for the client superset. And for the client Wonder Vision, it's $800 due in 0 to 10, which is 47% of the total dues. And again, from this situation, if you go below, like the last line, it says over 60 days. So for supersets, there is 0 receivables due in over 60 days, whereas for Wonder Vision, $35,000 are approximately due, which is 2%. So now this 2% of the receivable for Wonder Vision, which is $35,000, 34,780. It's basically, it can turn into a bad debt expense. Like these receivable are more than 60 days due. So there would be chances that you don't end up receiving this money. Or maybe even if you receive a little bit lesser of what you are owed. Maybe you allow some discount. So the idea would be that your receivables do not go more than 30 days, because if it goes more than 30 days, then there is a chance of losing, or there is a chance of uh, the receivables getting lower, or you making a discount to get your money back. So it is basically a loss in the profit that you are making. So like I told you that a product is $100, you pay $80 for the cost of goods sold, you make $20 profit. And the $20 is your profit. But if you don't manage your receivables on time, then you have to allow some kind of bargain, you have to allow some kind of discount. So the discount in this situation means that it is a loss in the profit that you are making. So if you allow £2 discount, $2 discount, and you ask them that, okay, fine, pay us $18 or pay us $15. So previously you are making $20 of profit. Now you will end up making $15 of profit or $18 of profit per unit. So you lost about $2 to $5 on 1 unit. And if you sell $1,000, you made a loss of $2,000 to $5,000. So this is a loss that you are actually making in the profit. You are supposed to make a higher profit, but you end up making lower profit. Accruals, we have already discussed that it can be your wages, it can be your taxes. These can increase spontaneously as and when the wages are due, or as and when the taxes are due. Accruals are free in that no explicit interest is charged. So if you take a loan from a bank, like current liability, then you end up paying interest on it. But on wages and taxes, you don't pay any interest on it. Some governments, yes, they charge, some governmental departments, yes, they charge some kind of interest penalty, but most of them do not. But it's not a hard and fast situation. Every department, every government's policy differs. So sometimes you end up paying interest on taxes as well, or any other liability that you owe to the government. You can pay interest on it, but it's not a hard and fast rule. And firms have little control over the level of accruals, because salaries, they have to employ employees to, the workers to, the laborers to work and convert the raw material into the finished good, depending upon the demand. So they have to naturally pay for it, the cost. And taxes are basically determined by the government policy, how much profit you are making, how big the company you are as an organization. And depending upon that, what is their idea of tax collection, what is their policy on tax collection, and they can dictate the terms. So you don't have much control over it. And the levels influenced by industry custom, economic factors, and the tax laws, as we've already discussed. The situation can be changing from an economic point of view, or the government can change the tax laws, industry laws, and you don't have enough control over it. Trade credit, credit furnished by a firm supplier. Accounts payable, as I told you earlier, often largest source of short-term credit, especially for small firms. Spontaneous increase, easy to get, but cost can be high. For example, 2 to 10, net 30. Now, 2% discount if paid within 10 days, but overall it's due in 30 days. So accounts payable is basically the loan that is your vendor is supplying you. The vendor is giving you the raw material free of cost, free of charges right now, but they have told you that, okay, fine, pay us in 30 days. But at the same time, they would give you option of that if you pay us back in 10 days, then we will give you 2% discount. So this is a negotiation which you can do with your suppliers, and it gives you a credit-free period, and you will not be charged credit. The cost of trade credit, like just an example, microchip sales on the terms of 2 to 10, net 30, which means if you pay us back in 10 days, you get a 2% discount. But if you pay on 30 days, you have to pay full price. So true price is 98% of the selling price. Now PCC buys a $100 memory chip from Microchip. If paid within 10 days, the cost is 98 because of the 2% discount. But if they pay in 30 days, they will have to pay the whole $100. Now PCC wants 20 extra days to pay cost. Again, $100. As I told you, there would be no discount. So the actual price was 98, but the $2 are actually the finance charges, because you are taking 20 more days to pay for the price that to pay for the product. So you pay a finance cost of $2, as highlighted in this example. So just a simple example of how much the client is getting as a loan. And in the previous slide over here, we discussed that it is often the largest source of short-term credit, especially for a small firm. To highlight this point, the third point over here in this slide, I would like to give you this example over here. So assume that PCC buys an average of $11.9 million of sales product from Microchip, which means that every day the client buys $32,667 dollars per day of sales. I've just divided this by 365. So if PCC pays on day 10, so they pay about, and they are not paying anything on that. They are not paying any interest. So the PCC company is receiving a credit amount of 3,26,000, 27,000 from the supplier. So these things actually highlight that how much credit you are paying. So previously you were not understanding the magnitude of credit, but now from this example, you can understand the magnitude, that the client is allowing you a credit of $3,26,000. Like without period, without anything, they give you a loan of 3,26,000, which you can use to generate, which you can use to run your operations and things like that. So it's important that we negotiate a good deal with the customer, because we are using this money, which is someone else's money, to run our operations. And our money, like this 3,26,000, if we had paid them on cash, then we would have been out of pocket. Out of this money would have been out of our pocket, and we would have paid them in cash. But because we are paying them on credit, after 10 days, we can use this $3,26,000 dollars in our other kind of activities, business activities like business expansion or research and development, or maybe we can build a new product line. We can finance a new machinery to increase our operation, and maybe invest in some other kind of business operations. This is the same example, but maybe for a credit cost point of view. So if the customer is taking 20 extra days, then the customer would have to pay an annual finance cost of $243,000, like in the last point. So if the customer pays after 20 days, then the actual money they would be paying would be 12 million instead of 11.9 million. And this means that the customer, the last point over here, this means that a customer is now paying 243,000 more. So you have to balance in how much the client can actually pay, how much the finance cost actually you can pay, so that you don't end up paying too much. Previously in the last slide, you were getting 26,000 credit from the client, but now you are paying 243,000 more as interest to the client. So you have to balance between these two. Again, this is a simple example of how you can run your business cycle. In this scenario, in this example, the company is running these business cycles 18.25 times a year, which is very good, which means the company is completing a cycle 18 times. They are selling the product 18 times in a year. And one batch can be 1,000 units, one batch can be 5,000 units or 10,000 units. And if you are selling 18 times the batch, 18 batches in a year, which means that you can end up selling anywhere about 100,000 units. If you are selling 10,000, units in one batch, and multiplied it with 18 times, then it means you are selling about 180,000 units in a year, and multiplied with the profit, which was $20. So I think you would be getting around maybe 3.6 millions of dollar profit, maybe something around that. Again, some kind of examples: effective annual rate. This is the interest cost that you are calculating. Cost of trade credit, 1 to 10 net 20, 1 to 10 net 20, and these are nominal cost, effective cost. These tell you that how much cost you are actually getting. So although it seems that the nominal cost is 36.9, but if you keep on repeating this throughout your cycle, it means that effective cost during the year, it becomes up to 44%. So you need to make a balance of all of these. I don't want to, bore you with all these calculations, so you can review it later on. And if you have any questions, you can always come back to me. You can have my email address or my contact number if you need any kind of help with the solutions. But during this lecture, we will just go through them. And if you need further help, you can always reach out to me. Okay, so just a few more slides. Trade credit, two components basically: free trade credit, discount period credit, and costly trade credit. It means that cost implied by foregone discount. So some credit are without any charges, and some credits are with interest charges. So you need to make a balance of these two, because sometimes you have to pay interest cost, and if you pay interest cost, then basically what you are doing is you are making you are taking away the interest from your profit, which means it reduces your profit as well. So you need to have a balance of free credit policy and the costly trade policy. Firms always prefer the free credit policy, but like I said, some things are out of your control, because this this policy is determined by the supplier. So you need to have a good relationship with the supplier. They should trust you, so that they allow you more better opportunities, and they charge you less interest on the credit allowed. Working capital financing policies. The policies can be moderate, as we have discussed. It can be aggressive or conservative. So we need to maintain a balance between these. Moderate policy would match the maturity of asset with the maturity of financing. Like I told you, matching principles: short-term liabilities with short-term asset, long-term liabilities with long-term asset, self-liquidating as well. Some of the asset and liabilities are self-liquidating, like they convert itself. It can be your account payable, it can be your account receivable. Like inventory is being self-liquidated through receivables. So when you receive the money from receivables, you pay it back, and then the remaining you can invest in the inventory. So it's also called self-liquidating as well. Aggressive use short-term financing to finance the permanent assets. Permanent asset means you always need some inventory, you always need some account receivable, you always need some cash with you, your machineries, your business operations, your building and stuff like that. Conservative means you use your permanent capital for permanent assets as well as temporary assets. So this is basically a chart of how the policies look like in a given scenario. Over here, if you focus over here, it says that temporary working capital can go up and down, and we see a very less short-term debt. But a permanent level of net working capital over here in this situation, it's over there. It's constant. Fixed assets are your buildings and machineries, and you have financed this fixed asset as well as permanent level of net working capital, which you know that you would always require through your long-term debt as well as equity. This is a moderate approach. Net temporary working capital can be your increase in inventory or increase in receivable due to a seasonal demand or maybe a cyclical demand, but it would not be there the whole year. And relatively aggressive approach, you have taken slightly more short-term debt because you want to increase your sales, you want to increase the market share, which is why you are investing more on inventory, which is why you are giving more credit period to the customer to make sure that the sales are increasing. So over here, you have taken more short-term debt from the banks and from other financial institution to supply to finance your net working capital cycle. Conservative approaches, you are not paying basically too much attention to short-term debt, and rather you take long-term debt, which as you can see from here, and you want to keep this conservative approach. You don't want to take too much risk, and which is why you only take long-term debt for machineries and your capital investment. But for the short-term financing, such as your raw material, your inventory, you focus on the amount of money that you already have, or you focus or you build a good relationship with your suppliers, or build a good relationship with your customers, so that you keep on getting money from them, and then start paying your the suppliers, as well as arrange for the profit, arrange for the inventory, raw material, and everything. So you are basically taking a conservative approach. You are not going too hard into the market, too aggressively into the market. This is basically the same slide, but a focused view, so you can have an idea. Same slide, focused view. Short-term investments, as I told you earlier, these are marketable securities, shares or bonds, and which can give you some kind of return. If you invest in shares, they will give you a dividend. It will give you capital return. What is dividend and what is capital return? So let's say if you bought a share of Apple right now in $100, and after 1 month the share price of Apple shares have gone up to $120. So that $20 is your basically capital gain, and you can sell the share back into the market in $120. You bought it for 100, you're selling it for 120, you made a profit of $20. But if you want to keep your stock, keep your shares right now, you're not selling into the market, and maybe 1 more month later Apple announces their annual results or quarterly results of how the business is performing, and they said that we will give $5 for every share to the clients who hold our shares. So you hold about you had 1 share of Apple, and Apple is going to pay you $5 for the dividend. So this is a profit sharing, which is also known as dividend. So you get $5 in profit. So you have not sold the Apple share yet. It is still with you. You can sell it anytime in the future. But even if you don't sell it right now, Apple is going to give you $5 bonus as profit sharing or as a dividend. And this is basically the safest investment, but at the same time, due to the changing economic scenario, the prices of a marketable security can go up or can go down. During the COVID period, all the market crashed, and if anyone had invested in the marketable securities, they made a big loss. But of course, that was also a time when the prices were at the lowest. So if you have good amount of cash available with you, you can invest in those times. You can take the advantage of low prices, and when the market stabilizes, then you can sell on a higher price to make good profits. Okay, short-term financing, again, you have to take it from the bank, and you have to pay some kind of interest on it. And if you don't pay on time, you will have to pay some penalties as well. And if you don't follow the procedures or follow the plans or the contractual agreement with the bank, then you can face lawsuits in the court as well. So you have to make sure that you are adhering to the terms, and you are abiding to the laws and the contractual agreements between you and the financier. Disadvantage is basically a higher risk. The rates can go up, down, depending upon the situation. If you have taken a short-term financing and your stock is not being sold, or your customers are not paying, then you have to pay back to the customer. You have to pay back to the bank. And if you don't pay back, then again, as I told you, it's a higher risk. You will have to face penalties, or you have to pay. You have to go to the court to settle this agreement or this dispute. Interest rate also fluctuates depending upon the government policies. So if the interest rate increases, you have to pay more interest. And sometimes the economy suggests that interest rate should go down, then you can benefit from it, because now you're paying less interest. So these items, these elements are out of your control. You can just hope that, or you can just do a basic calculation or forecasting, but these forecasting cannot be very accurate. Sometimes some elements are out of your control, and these things do not help you much in this scenario. Short-term bank loan, it's the same thing. We also call them notes payable as well. Maturity is less than 1 year. It can be 1 month, it can be 6 months, but maximum 1 month. The loans which have a life of more than 1 year can be medium term. Medium term is basically 3 years, and long term, which is 5 years or more than 5 years. Promissory note, it is signed when the bank loan is approved. So you sign the promissory note. It specifies the amount, how much loan you are taking from the bank, at what interest rate, what is the payment schedule, like on when are you going to repay the loan, and how many installments, maybe on the first of every month, maybe once in a quarter, maybe half annually, maybe yearly terms. It depends completely upon the bank's agreement, bank's policies, and what collateral or security are you going to provide to the client, provide to the bank. So let's say if you are taking a car loan, right? So you know that the car loan is maybe $10,000. So the amount would be $10,000 and the interest would be 2%. So you are taking a loan of $10,000 from the bank to buy a car. So you will pay $10,000, but on top of this $10,000, you will pay 2% interest rate as well. Repayment agreement is basically for a car loan. It will be monthly installments which you pay to the bank, and the collateral would be the car itself. Because if you don't pay the installments on time, the bank officials can come and take the car away, because the collateral was the car itself. Or in the house loan, the collateral will be the house itself. So the bank will ask you with the court's notice to vacate the property, and they will put the property on sale. So if you don't abide by the policies, if you don't make your payments on time, then you will have to face consequences as well. Compensating balances, it's the same thing as effective loan rate. It increases the effective loan rate, and sometimes it's illegal as well, because now you have to pay the damages. But some states say that no, the liability is liability. Whatever you have you previously agreed, you have to abide by that, and there would be no increases. Informal line of credit, maximum amount bank will extend. So informal line of credit is again an agreement with the bank that the bank will provide you maximum this much loan and not more than that. Revolving credit agreement it's a formal line of agreement. The bank agrees that okay, you can use $10,000 of our loan, of our money, and it will be revolving, which means that you can use 10,000 and then you pay some amount back, maybe 1,000 back into the bank. So now the loan is at 9,000, and then again you can use that 1,000 again. So it keeps on revolving. Like you borrow the money, you make the repayment, there is a cushion, you borrow the money again, you make the repayment again, the cushion is available, and then you keep on doing that. So this is basically a revolving agreement, and the bank is legally obligated to honor this agreement. So if you have agreed revolving credit line, then the bank will not ask you to return the money then and there. They will have to honor the agreement as well with you for a certain period of time. If the line was agreed, if the credit line was agreed for 1 year, then they have to provide you that amount of money for 1 year. Informal line of credit is basically a long-term loan, and you will only get a disbursement of that amount one time, and you make on repayment. There will not be further drawdowns. Further drawdowns mean you will not make further payments from that account. Now you have to do is what you have to do is, you have already taken the loan, now you keep on making the payment. You cannot do further drawdowns, so you cannot use further amount of money from that account in the bank. Commercial paper is basically a company, a big corporate client in the market, and they issue a commercial paper. Commercial paper is just like bond. So the commercial paper itself has a maturity of 1 to 9 months, maybe average 5 months. But they tell you that you buy the paper from the corporate client, and the corporate client takes the money from you, and they return it back in certain months along with interest. So you are making certain payments as well. So instead of taking the loan from the bank, the company itself launched a bond and generated money from the general public, and they pay them according to the agreed interest or agreed dividend. And so, most of the times commercial paper is less expensive for the bank, for the client, as compared to a bank loan. So if the company has a good policy, the good reputation in the market, and they have a policy around this commercial papers scenario, then they can of course issue bonds, and they can lower their cost of financing as well. Okay, the final slides, and after that we can have a question answer session. Security in short-term financing is basically commercial papers are never secure, because the commercial papers are issued by the corporate clients itself, and you are taking a risk. Because if I tell you that one of the large Indonesian companies, one of the biggest Indonesian companies, oil producing or oil exploratory company, or anything like that, supermarkets or cement, steel, they are issuing a commercial note, and you know that this company is really famous and they will give you some kind of return. So you invest in that company's bonds or commercial paper, but you don't have any security as to if what happens if the company does not return the money back to you. You don't have any security in that. If they don't return it, you lose it. It's that simple. You lose some money. So you are taking some risk. But why are you taking that risk? Is because the company has a good reputation. The company has been in the business for maybe 10 years, 20 years, for a long time, 50 years, and they have been honest. They have been producing good products, and you trust that company. So which is why you are investing in that company. And better to borrow on an unsecured basis as well, because it keeps the cost lower. Collateral options are again marketable securities, land or building, equipment, inventory, receivable. So sometimes these are if you borrow from the bank, then you have to pledge your marketable securities or your shares. You have to pledge your raw material or buildings, your land or machinery, inventory, or you borrow you make an agreement of assignment of receivables, which means that the first receivable that come to you from a client, from a customer, will directly go to the bank instead of you. So this is called assignment of receivables as well. So these are some of these terms are banking terms. I was previously a banker before coming to the UK. Right now, I'm a financial controller in one of the companies here in UK. So some of these terms are banking terms, which you may not be familiar with. So if you feel like you don't understand anything, then please feel free to ask me, or take my contact number if you have any questions, or my email ID, and you can always reach out to me. There are no problems. I will try my best to respond back to you as soon as I can. Thank you. And the lecture ends here. If you have any questions, please feel free to ask.
Okay, guys, we move to the next agenda is Q&A. For the participant, if you want to ask a question, please use the raise hand feature.
Any questions? There is one question from Jao.
Okay. Oh. Okay. Please, Osana Jao. You can ask.
Hello.
Yes, Jao. Please go ahead with the question.
Oh, okay. First of all, thank you so much for your presentation.
My pleasure.
I guess it was really wonderful. I have a question that I wanted to ask. In one slide, you talk about firms giving credit payment options to their customers to keep them coming. So my question is, what is your take for like small firms that rely on financial institutions to get loan and run their businesses? If they give their customers this credit payment options, will it help them like in terms of generating cash to buy more inventories to expand their businesses?
So for small clients, for small companies, of course, they can extend the credit period to increase uh, their sales. But the problem would be that they need some money from the bank or from financial institutions to run the operations. Because if they are extending credit to the customers, they would not have money to generate to make new raw material purchases and then convert into finished goods or make new sales. So they will have to rely on banks. Banks don't easily provide credit to small companies with low repayment history or low financial history, which is why the small companies will have to go to a microfinance organization. Microfinance organizations support the small organizations, small companies, and give them small credit loans based on the scenario. And they give them a client agreement that, okay, we will give you $50,000 or maybe $10,000 or even low. Micro loans are very low. Loans are not like bank where you can borrow even $1 million. So micro loans are very low. But as and when you support these repayments, and as and when you support your financial management, if you and and your clients are paying you on time, then of course you can eventually grow big. And you can every company has to file annual statements, and based on those annual statements, annual returns, and basically your financial history, you can go to a bank and negotiate a better deal, because now you have performed, you have a good history of your financial situation, your financial health. So yes, then after you can negotiate with the bank. But in the initial phase, you don't have many options. As a small supplier, as a small company, you would have to go to a microfinance organization who can support. Microfinance organizations are different as compared to banks.
Thank you
Does this
so much.
clarify your question?
Yes, thank you so much.
My pleasure. Any other question?
Perhaps while waiting for the other questions, I have some
Yeah.
question. So maybe it's like a basic questions, but for me, I believe it's really important. What kind of problem that usually occur I think in working capital management? Because I saw that the purpose of working capital management is to generate some shareholder wealth through obtaining optional profits. So investor can know the company is. So based on your opinion, what is like some problems that usually occur?
Yeah, a very good question, because every company's motivation or the aim is to increase shareholder wealth, like to increase your profit. But if you're not managing your working capital efficiently, like I told you that if you borrow from the bank, you have to pay the interest, right? So interest expenses are deducted from your total profit. So if you pay a lot of interest or a lot of such cost or penalties from your total profit, then your total profit, actual profit reduces, and you have already made a large amount of investment in your business. Investment is your total cash, total inventory, total raw materials, your fixed assets such as land, building, plant, and machinery. So these are heavy expenses. And if you are making losses out of your profit, so like you sell a product for $100, your cost is $80, you made a profit of $20. This is your profit. But out of this profit, now you have to pay back interest to the bank for the money that you had borrowed. Or if you did not make payments on time, then you have to make a penalty payment for late or missed payment. So these interest elements or these penalty elements are deducted from your $20 of profit, which I gave you in this example. So now maybe your profit is reduced to $15, let's say $15, and you made a total investment of $100 earlier. So you were getting a 20% rate of return for the shareholder wealth, which was really good. But now after making interest payments and now after making the penalty payments, your profit is reduced to $15. So if I take the investment again at $100, now your return on investment is 15%. So you lost about 5% of shareholder wealth. So all these scenarios can be a problematic situation if not managed well. But if you are a big company and you know that you have no other option, but you have to ensure that you have to provide credit line to the customer, you have to pay to the bank for the suppliers, then all these factors taken into consideration, you make a certain good rate of internal return, which is also called IRR, internal rate of return. So the board of directors decide that, okay, our internal rate of return target for the year is this much. You can exceed it, which is very good for the organization for the growth, but you can you can undermine it as well, which is not good for shareholder. So you have to make a balance, and which is why the financial management, financial analyst, or the financial controller comes into the role to, give you a direction of how the company is going, what things are effective, and how you can improve it further, the whole business situation. Does this clarify your question?
Yeah, clear enough, sir. Thank you.
Thank you. Any other question?
Please, for Miss Adinda Nura, you may ask.
Oh, okay, sir. I want to ask about what type of business that will benefit the most with the lockbox system.
Sorry, with the what?
The lockbox system.
It's totally up to you. There is no ideal business situation. It's totally up to you. Lockbox system is basically it's like a pot. It's like a saving account. Lockbox is not for it does not have any impact on the business that you are doing. Lockbox is just an account. It's just an account for your saving. But yes, the question that which business is more promising, it can be again depending upon the situation you are in. As I told you that first you have to identify a problem which which the general consumer is facing, and then you identify a solution for it. If the solution is in technology, technology is good for you. If the solution is good in household, the problem you face is household problem, then you identify a household solution. So it depends upon you as a person, as an individual, that which area you are interested in. Accordingly, you can set up a business around that problem, provide a solution around that problem as per your area of interest. And then when you are making profit, then you can set up a lockbox account, and then you keep on your profit at one time for every month on the particular day, a particular amount, and then you can keep on making some of the savings. Does this clarify your question?
Yes, sir. Thank you so much.
Anyone else? Any other questions?
Maybe it's in for the question session, sir, because it's already Margaret here, and also maybe there is no questions so far from the participant.
No.
And
Okay, no problem. We can proceed ahead.
okay,
If anyone has any question, then you are free to ask. If anyone wants my contact number, or you can contact the International Program of Accounting and take my contact number from them. I will be happy to answer any questions if you want to have a discussion later on.
okay, thank you, sir. Thanks to Mr. Jazib Ali for the attractive material, and thank you for the answers given to the questioners as well. Hopefully, it can help the audience to have a better understanding of working capital management. Now, we are returning to the last agenda, which is closing. As the master of ceremony, I do apologize for any mistakes during this event. Finally, I say thank you. Before leaving this event, kindly please everyone turning on your camera because we want to take a picture. I repeat, kindly please everyone turning on your camera because we want to take a picture.
Mr. Jazib, Assalamualaikum.
Waalaikumsalam.
Yeah, I'm Rizal. I just joined the session. I did hear your last explanation. It's very nice, and I myself would like to look at the video record of this, the one that you presented. I'm the one who teach the class. Apologize, I missed some part that you listen. Really
No
nice
problem,
to
sir.
meet you. Thanks a lot. Thanks a lot. Yeah, we keep in touch. Yeah.
Same here, definitely. I hope I did justice with my role today, and I tried my best. If, of course, if there are any questions, if anything is not clarified, you and your class are happy to reach out to me, and I will be happy to share my knowledge. And as you just joined the session, I was informing to the clients that I basically come from Pakistan, and I was a banker over there for 6 years in some of the top banks. And right now I am in UK. I completed my master's degree from University of Bradford and working as financial controller in one of the companies here in UK. So I have a good financial management background, and the students are more than welcome to contact me directly in terms of any career advice or any questions if they have. I would be more than happy to share my knowledge with them.
Great. Thank you
And
so much.
yeah,
Thank you so much.
Mr. Rizal, I'm not sure if you already know, but I was in UMI as well, University of Muhammadiyah, in last September for about 1.5 months. So it was a great experience with all of you. And Professor Eko, Professor Noor Mandi, Miss Olia. So it was a great experience. And I, of course, owe this to you guys to share my knowledge and the hospitality that I received, the welcome that I received. So going forward, if there are any collaboration opportunities, please feel free to contact me.
Great. Thank you so much.
My pleasure.
I did my PhD in the University of Aberdeen, up in Scotland, Aberdeen.
Right.
Yeah. Bradford. Prof. Eko is he's in Bradford before. Unfortunately, I do not have time. I could not make to go to Bradford. Just to Newcastle and then London and area around that. Hopefully, we can meet one day.
Of course.
Thank you so much.
Of course. Yeah. Professor Anand from University of Bradford has a good collaboration situation scenario with University of Muhammadiyah as well as Professor Eko, and we were also there. So it's always a good opportunity to share our knowledge and expertise with each other.
Okay, sure. Thank you so much.
Inshallah.
Okay, we have a photo session.
Yes, sir.
Yes. Okay.
Yes. Okay, so
Okay, Arif,
take
yeah.
a picture.
Okay, turn on the camera, everybody.
Please for the
Andi,
participant, you can-
Muhammad Arif, Joe, Axel, Hisham, Amanda, Maulana. Okay, Arif.
Yes.
Yeah.
We will count.
Yeah.
Ready? 1, 2, 3. Okay. Once more. 1, 2,
thumbs up.
3. Okay, once again. 1, 2, 3. Okay. Thank you for your attention and joining this event. Also, thank you for Mr. Jazib for
Yeah. Before we go, I just want to say a few words that I learned while I was in Indonesia. Don't judge me on my pronunciation, but I will try my best. Aku cinta Indonesia.
Sure.
I hope you guys like it. Thank you very much. Take care, guys.
Terima kasih, sir.
Thank you very much. Bye.
Thank you so much.
Sama-sama. Bye.
Okay, and thank you for Mr. Rizali also that already joined our events, our general lecture. And also for the participants, see you in the next event. Wassalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam.
Waalaikumsalam warahmatullahi wabarakatuh.
Ya, Arif, masih ya. Thank you. Yep. Okay. See you next week in class.
Yes, sir. See you.
Yes, sir.